I'm Paul Giannamore. I'm an investment banker and I negotiate for a living. Today we're going to talk about private equity. What is it? What does it do? And is partnering with private equity right for you? At its core, private equity funds pool capital and they invest them largely in privately held businesses. Now I say largely because at times there's investments made into publicly traded companies from private equity firms, and those are referred to as PIPEs, or private investments in public equities. But for our purposes today, we're going to focus exclusively on the investment of the pool of capital into privately held businesses. And private equity firms do that largely in one of two ways. On the one hand, we have a buyout shop. And a buyout shop, just like American Capital, would largely acquire between 51% and 100% of a business. They want to buy a controlling stake in a firm. Then on the other hand, we have minority or growth equity investments, and I typically will batch VC or venture capital into that mix. And a minority investment or a growth equity investment is taking a minority stake in a business, 20%, 25%, 30%, in order to assist the company with growth, with the eye on an IPO or some other exit at some point in the future. Now, private equity firms get their investment capital from a variety of sources, whether it be a retirement fund, a sovereign wealth fund, or even individual investors. I, for example, invest individually in private equity funds. An example of a private equity fund formation would look like this. We have 2 or 3 guys that either have industry experience or perhaps come out of investment banking, or perhaps even leave another private equity fund. They get together and say, hey, let's raise our own fund. What they do is they set up a general partnership, and that general partnership invests into a limited partnership, so kind of a closed-end, limited duration partnership. In the US, we tend to see it about 10 years as average. That general partnership will put capital in, sometimes 5%, sometimes 10% of the total amount expected to be raised. And then the practitioners or the private equity professionals go out into the community. They deal with pension funds, retirement plans, so on and so forth. They raise capital from limited partners. So those limited partners now are partners in the fund. And as the private equity professionals begin to deploy that capital or make buyouts or make minority investments, in the first 2 to 3 years of the fund, that's when they're deploying capital. And as they are deploying capital, they're calling it, meaning on the front end, the investors aren't necessarily writing the check for the full amount. So in this particular example, let's say it's a $100 million fund. You've gone out, you've raised $100 million. I'm your investor. I say, I'm going to commit $10 million to the fund. I'm not writing a check for $10 million today. I'm writing a check typically as it gets called over a period of time. And that might be 1 year, 2 years, 3 years, so on and so forth. But as private equity firms call in that capital, they deploy it, and by the time they get into the middle of the fund, that's when they're really focused on the value-creating aspect of holding portfolio companies, which we're going to talk about today. Finally, when you get to the end of the fund life cycle, that's when the private equity firm is ultimately looking to divest or exit its portfolio businesses. And those exits typically are either public offerings or sales to other private equity firms or sales to strategic or industrial buyers, for example. Now, one of the questions I get often is, how do private equity funds actually make money? And here's how they do it. Private equity firms get their returns kind of in the same way that you, a business owner, would get a return in your business. Capital appreciation and dividends for a business, and private equity, capital appreciation and management fee. So when the general partner sets up a fund, the fund raises capital. On the capital that the fund collects, it typically takes a management fee. Now, in the United States, that can range anywhere from a few basis points all the way up to 2, 3, 4%. In the industry over the years, we've typically heard about 2 and 20, which is a 2% management fee and a 20% carry, or 20% of the upside in capital appreciation goes to the private equity fund. And let me give you an example. Let's say that this private equity fund that we just established is a $100 million fund. It raises $100 million and begins to take a 2% management fee on the assets that it manages. It goes out and deploys some capital and it buys a $10 million business. And let's say it buys a $10 million business in year 1, and in year 7 it exits, and that business is a $30 million business at that point in time. The capital appreciation, the $10 million that we started, And the 30 that we exited was 20 million, right? That's the delta between 30 and 10. So we've got 20 million in capital appreciation. The private equity firm will take 20% of that capital appreciation. So in this particular case, we're talking about $4 million plus the 2% that has been taken over time. And later in this series, I'm going to talk a little bit about management fees, and I'm going to talk a little bit about carry, because every private equity fund is different. And I think it's important for business owners to keep in mind that some private equity firms, if you were to partner with them, so they, let's say, for example, do a control buyout of your firm, you've sold them 70% of the business, you've retained 30 for yourself. Some private equity firms will actually take a management fee on your own business, the business that you've partnered with, and others will not. They'll say, we're partnering pari passu with you. We're not taking a management fee because we're partners. Other private equity firms will take a straight 20% carry, a straight 20% off the top. Others will have specific required rates of return for their limited partners, for example, before they get paid. So there's a little bit of a nuance in the deal structure that I think is important to pay attention to, but we'll get into that a little bit later in the discussion. So if private equity has reached out to you, feel free to reach out to me. You can contact me on the contact form below in the description, as well as you can always reach me on LinkedIn. I'm Paul Giannamore. Thanks for joining me today. I'll see you on the next one.